This example includes a compound financial instrument. Griffin Limited issues 2,000 convertible bonds on 1 January 2012. The bonds have a 3-year term and are issued at fair value and a face value of 1,000 Rand per bond, giving total proceeds of 2 million. Important to identify, guys, that this 2 million will be our future value of this bond. Interest is payable annually in arrears at a nominal annual interest rate of 6% per annum. You need to identify that this is the actual cash outflow, the payment, the 6% times 2 million. Each bond is convertible at the option of the holder into a fixed number of ordinary shares at any time up to maturity date. On 1 January 2012, a market-related discount rate for a basic 3-year debt instrument for Griffin Limited is 10% per annum. Now we can identify that we need to use this 10% to determine what is the present value of our convertible bond. On 31 December 2012, it seemed very likely that the holder will exercise his right to convert the bonds into a fixed number of ordinary shares in the next 2 months. However, by 31 December 2014, the holder had not exercised this right and the bonds were settled in cash. Now guys, when we look at our steps, step 1, in terms of IAS 32, we are looking at this from the perspective of our issuer. Therefore, in our issuer's records, this is either a financial liability or equity. But now when we look at the information that they provide to us, our holder has the option, therefore guys, to either receive shares 1 or cash 2. This will be a compound financial instrument, therefore a liability and equity portion, a compound financial instrument. And we need to identify our steps. Determine the fair value at initial date. Guys, they've provided us with the 2 million. This is our value at initial date. Step 2, what is the present value of the liability? And step 3, we need to calculate our equity. Now, when we look at our steps or classification rather, guys, let me include this, our classification of IFRS 9. How do we classify a financial liability? Remember, financial liabilities will automatically be classified at amortized cost or exception at fair value. Remember, this can be 1, when they are held to trade, 2, when they choose this, or 3, in terms of a business combination. Now guys, this is on your revision page. And we have identified that this will be at amortized cost. Why? There's no information relating to trading. There's no information relating to the fact that they have chosen to recognize this at fair value, and this is not a business combination. Therefore, we now know that this will be a financial liability at amortized cost. Now we need to follow our steps. Step 1, we need to determine our value at initial date, and they've provided this to us, our 2 million. Step 2, our present value of the liability. We have our 2 million. We have our payment, 120,000. This will be the 2 million times 6%. Period is 3 years and market rate 10%. Therefore, our liability portion will be 1801052. And step 3 will be our equity. In our journal on the 1st of January, we need to recognize this transaction. Therefore, we will have to credit the liability. Remember, liabilities increase on the credit side, our financial liability at amortized cost. Then guys, important, we need to include our equity portion, and we debit our cash, our bank. Why? Griffin received the 2 million. Now at the end of December 20.12, which is our first financial year end. Important guys, you need to recognize the actual cash outflow, the actual interest paid by Griffin. Therefore guys, this is our cash outflow, and this will be the 2 million times 6%. Now this will happen each year guys. Do you see? We will have to credit our bank with 120,000. And we then need to calculate our effective interest. Remember, this is at amortized cost. Therefore, you need to use your amortization schedule. Or guys, you can calculate this based on the balance of your liability. Now, what do I mean by this? If you look at our first journal, we've recognized a liability of 1801052. Now, this is on 1 January. I'm going to include this on our timeline. 052, and our market interest rate is 10%, therefore times 10%, and this will be our effective interest rate. Our effective interest rate. I'm going to highlight this pink. Okay. Now, at the end of 20.12, what will the balance be of our liability? Remember, we need to recognize the remaining difference in our financial liability at amortized cost account 60105. Therefore, our balance at the end of 20.12 will be the 1.8 million plus the 60105 times 10%, and this will be our effective interest expense 186,116. And again guys, you will have to debit the interest expense with the 186,116, and the remaining balance amount will be recognized in our financial liability account 66116. Now guys, the same principle with 20.14. Then at the end of 20.14, the bond is settled in cash. Therefore, we need to take out the financial liability, as our financial liability will now be 0. We debit the liability, and we will have to credit our bank account with the 2 million. You will identify at the bottom of our screen that I have included options. Now, when they provide us with a scenario where the likelihood that the holder will receive the cash or exercise the right to receive cash, you will identify that our financial liability will be the greater amount between the financial liability and equity component. Now, when you look at our example, liability 1.8, equity 198,948. Now, when the likelihood is greater that our holder will exercise the option to convert into shares, our equity component will be the higher amount between the two.